Okay, it looks like most all of us are on the line right now. We're going to mute the phones for the folks that aren't speaking. Again, just wanted to welcome you to today's webinar. My name is Adam Goldstein, the Chief Business Officer at the Federal Home Loan Bank. If you have questions, please submit them at any time through the question box, and they'll be answered at the end. I want to remind you that as a response to the COVID crisis, we've created this webinar series to bring educational content in the remote working environment, which is kind of the norm for all of us. In fact, this is our 15th webinar that we've done since we've been in this remote posture. As always, we're looking to continually enhance the programming. So we ask that if you have any comments or questions or suggestions for future webinars or educational content, just please let us know. There'll be a survey, and we do value your input to cater these sessions to what you, our members, are most interested in. We also encourage you to visit our financial intelligence library, where you can listen to feature podcasts on LIBOR SOFR transition and see a lot of articles written about different types of strategies. There's so much content on there, and we value your input on that as well. But take a look at that when you get a chance. There's also information there about the dividend announcements, PPP loans as eligible collateral, which just newsflash, I saw an email come across this morning that said we're up to almost $5 billion in members pledging PPP loans to us. So we're seeing quite the increase. We encourage you to pledge those loans if you have them to us. We'll be happy to provide liquidity against them. The second round of Home Buyer Dream Program funding, good news, bad news. The good news is the funding is getting to people that need to get into homes for down payment and closing costs that otherwise might have trouble owning a home. That's the good news. The bad news is the funding's exhausted relatively quickly. We opened up another $3 million and it was gone within an hour. So we appreciate that our members are using the product. Obviously, free money is a precious resource, so we can only do so much as a cooperative. But the more our members do with us, the more we're able to do in terms of these types of programs to support all of you in home ownership and community economic development. Also, another reminder that if you are an MPF member where you're selling loans into the MPF program or are looking for another outlet, later this year we are converting to our new mortgage asset program, where our members will be selling us some loans as another means of providing liquidity. We've had 4 informational webinars. We're going to do a few more of those, but if you have any interest in that program or would like some more color, please just reach out to your relationship manager, 212-441-6700, and any one of us can help you and send you some materials on that program. So apropos to today's topic about the economy and the business environment, the business recovery in the face of the pandemic, I'd like to mention that the next arm of our disaster relief funding, the business development advance, we call it the BDA, is set to launch later this year, which is 0% advances to you, 0% financing for unqualified loans for small businesses. Again, this is to really do our best as a Federal Home Loan Bank and a partner with you all to support your community. So we'll continue to offer these programs as you continue to use the product, services, and programs as part of your membership in the Federal Home Loan Bank. So with those introductions, I'd like to do an introduction of my own and introduce Tom Citino, the Vice President, Director of Member Relations, to tee us up for today's webinar. Tom, take it away.
Hey, thank you, Adam. Good morning, everyone. Appreciate and want to thank everyone for attending the session. So it's my pleasure. I'm going to be introducing Brian Jones, a friend of mine. He's our financial economist at the Home Loan Bank of New York. Brian comes to us, we're lucky we got him. He comes to us with over 3 decades of experience. He's been covering the U.S. economy and the financial markets for years at a variety of leading institutions. Most recently, he was at Societe Generale, but his experience also spans from Citibank, Solomon Smith Barney, Lloyds Bank, and then Urban Trust. And in those institutions, he covered all aspects of fixed income, currencies, and commodities across the business lines of those employers. So Brian's been with the bank for approximately 3 years, and he provides macroeconomic analysis and strategic insights to our bank, which is information that's utilized across the organization. So Brian's presentation today is titled How Strong a Rebound. He's going to be speaking about what we can expect from a recovery as we proceed further through this pandemic. So I'm excited to hear Brian speak, and with that, I'm going to turn it over to Brian.
Good morning, everybody. Well, having gone through the worst economic contraction since the summer of 1932, the question now is, what sort of a rebound do we anticipate is forthcoming in the U.S. economy over the next several quarters? Early projections are that the economy probably bottomed in April, and we actually have been recovering from that point on. The current estimates that we have available, and there are a variety of them for current quarter growth, they center at about 17.5%. But again, pretty much everybody's looking for a double-digit increase in growth during the current quarter. The Atlanta Federal Reserve Bank, for example, they've got the highest estimate right now at about 20.5%. I think their estimates in particular you want to pay attention to. Not only did they come closest to the pin in the first quarter with their estimate of the decline that we have in the spring, but more importantly, with every new report that comes out, the Atlanta Fed marks their forecast to market. So, for example, we'll get an important update tomorrow on the heels of the retail sales and industrial production reports for the months of July. So those numbers will probably come out somewhere before noon tomorrow morning. But again, that'll be your best update on what's actually going on right now. As far as the contraction and the likely recovery, most of the downturn that we had in the second quarter, it was concentrated in consumer spending. We also had pullbacks in business fixed investment, home building activity, and also inventory building. And when you have an economy that's 70% concentrated in the consumer, that's where the likely rebound is going to occur. That's where the majority of the juice in the third quarter is likely to come from. The numbers that we have in hand right now suggest that the economy is probably going to suffer a 5% calendar year decline this year. But again, remember, those estimates are in flux. Why I bring that up is that in the last summary of economic projections that came out of the FOMC meeting in June, they were calling for a 6.5% decline over the course of calendar 2020. So actually the numbers are coming in better than the Fed had anticipated at that point. When you look at the U.S. economy, what's the most important thing? It's consumer spending, and what drives consumer spending? That's going to be the labor market. Now, there we have had some considerable improvement over the last several months, but, as they say, we have miles to go before we sleep. Jobless claims, even including this morning's report, moving back below the million mark on new claims, we still are levels that are tremendously elevated relative to what we've seen in the past. And even if you look at the right-hand side chart on slide number 4, you see that we've basically recouped in aggregate about 42% of the jobs that have been lost. The places that we've seen the most encouragement have been in construction, where we've gotten back 60% of the jobs lost there, and also hard-hit sectors such as retailing and leisure and hospitality. The retail sector lost 2.4 million jobs, and we've recovered about 1.5 million of those jobs. So about almost 62%, almost 2/3 of those job losses we've gotten back. And leisure and hospitality, which is I think the sector that's going to struggle most until we have either reliable remedies for COVID-19 or vaccines. They've recouped about almost half of the 8.3 million jobs that were lost in the wake of the shuttering of the economy. Turning to the next pack, as bad as the downturn was in response to the COVID crisis, chances are that when the National Bureau of Economic Research actually gets together, the Business Cycle Dating Committee, and calls the trough in the economy, chances are they may actually place the trough as early as April. Their probability of recession in March and April using the Federal Reserve Bank of St. Louis's model, which basically mimics the NBER Business Cycle Dating Committee's process, was at 100%. Over the last 2 months, we've come down to 39% in both May and June, and that's probably headed lower in coming months. So again, this in all may have been just a 2-month business cycle downturn, and that compares to what our historical average is, which is about 11 months. Looking further out, the Federal Reserve Bank of New York's model, which rests on the slope between 3-month bills and 10-year notes on a bond equivalent basis, they place the probability that we'll be in recession about a year from now at just 20%. So the recession probability numbers are certainly going in the right direction as well. Turning to the next slide, the most impressive thing when you try to gauge what kind of a rebound we might have is to look at economic surprise indexes such as the one that's been constructed by Citibank. The data that's been coming out over the past several weeks, not only have the numbers been good, but they've exceeded consensus expectations by a country mile. I mean, if we look back at the data going back to the early 2000s, we've never seen observations on the Citi Economic Surprise Index such as those which we've been getting recently. Those suggest that we are going to get a pretty sharp snapback. But also, if we turn to the next slide, you'll see that a lot of the economic variables that we track, they've already recovered to their pre-crisis peaks. They're back to either at or above where we were when the last last expansion was dated to have ended in February. Both ISM measures, manufacturing and non-manufacturing, are well above the 100-point mark, which was where we were in February. And what's very important for us, because we've got so much of economic activity concentrating consumer spending, even control retail sales, which strip out autos, building materials, and gasoline, because the Bureau of Economic Analysis actually uses unit numbers to forecast those components of GDP. We're way above the levels that we experienced before this recession began. The areas that are having a tougher time, as I said before, I mean, we know the labor market has significant ground to make up. Hours worked as a result have ground to make up. Non-defense capital goods or plant equipment spending, they've got some room to grow, and certainly motor vehicle sales, which got crushed in the wake of the shuttering of the economy. They've got a considerable way to go right now. Turning to the next slide, there's a lot of real-time indicators that we can track on a weekly basis to get a sense of how the current recovery is progressing. One of the traditional ones is to look at railroad traffic across the economy. And you can see, at least in the left-hand side panel, both panels, that total U.S. rail car loadings or intermodal traffic are well off their bottoms. I mean, they still have a considerable way to go to last year's levels. I mean, intermodal traffic is almost there. Normal rail car loadings have a significant amount of way to go. But again, we're getting a fair amount of progress here. And this is consistent with what we're seeing in other manufacturing soundings, whether it's the ISM numbers or what we're seeing out of the Federal Reserve's Industrial Production Report. Other areas, even some service sector areas of the economy are starting to improve. And again, these were the most severely impacted by the shuttering of the economy. Hotel occupancy rates, they're still below normal levels for this time of year. They're well below the median activity that we had over 2000 to 2018. But again, they're headed in the right direction. And even if you look at the right-hand side panel in slide 9, you'll see that even if we look at restaurant traffic, it was improving sharply as segments of the economy reopened. There were some setbacks in portions of the nation that may have opened prematurely, but they haven't fallen out of bed. We have since seen recoveries after the initial setbacks in Georgia, Florida, California, for example. And New York restaurant traffic continues its steady climb higher. We have a long way to go here because there's so much social contact that's involved in the restaurant industry. But again, the numbers are improving. If we look at things also to give us an idea of what's going on in the economy and the consumer in particular, I mean, gasoline consumption by American consumers is now almost it's within 10 percentage points of where it was this time last year. So consumers are returning to the road. You can see that in the left-hand side panel in slide number 10. And we are, although this is going to take a long time to recover, we are starting to see some pickups in public transit across the country in a variety of areas. Again, because there's a fair amount of social contact involved in public transit, those numbers are going to take some time to get back to the levels that we saw in the first 2 months of the year. And you can see that in the right-hand side panel in slide number 10. There are areas of the economy though that they're going to take a long time to come back. The one that stands out is air traffic. Although we seem to be on a gradual uptrend in air traffic, you can see in the left-hand side panel in slide number 11 that we have a long way to go to get back to where we were on the levels that we experienced last year. And if you look at the right-hand side panel on that chart, you can see that because of the restrictions on social contact across the country, movie ticket sales are essentially dead. There's nothing going on there, and that's not going to. That may of the two of these series, that'll probably take the longest to come back, because I think it's going to be a long time, possibly until we have the vaccine available, before people feel comfortable sitting next to somebody and watching a movie. Turning to the next slides, as far as inflation is concerned, the one thing that's a result of the pandemic is that the inflation numbers are going to remain well below the Fed's target level throughout this year, and probably they won't approach the 2% mark, core inflation measures, excluding food and energy components, until probably late winter, early spring of next year. So right now, as far as the Fed's dual mandate, inflation is not even on their radar screen. They're not concerned with that at all. They probably won't have to be for some time. In fact, chances are that once the economy is on a firmer footing, given that there's been such a long undershoot on inflation, the Federal Reserve is probably going to let things rip, and they'll probably tolerate a significant period of time in which we have above 2% inflation. Turning to the next slide, another encouraging thing is that financial conditions are back in accommodative territory as of this morning. Bloomberg is one of many measures that tries to get an idea of how tight or accommodative financial conditions are in the economy. Basically, all of these measures, regardless of who constructs them, they incorporate the same things, whether it's money market spreads, bond market spreads, equity market readings, and also market volatility soundings. But you can see that we have had a pretty stunning improvement, almost 6.6 standard deviations since the low that we hit in the midst of the coronavirus crisis. And we've come ripping right back. Basically, it's been because of narrower bond market spreads. The most recent improvement is because of narrow bond market spreads, higher equity prices, and reduced equity market volatility. But what's interesting here, if you look at the left-hand side chart, is that you can see that, and I think this has to do with the fact that the Fed was so aggressive and the Congress acted promptly in coming out with measures to stem the crisis. The recovery in financial conditions has been extremely impressive. I mean, to be fair, in the midst of the great financial crisis, 2008, 2009, it took us almost 2.5 years to get back to neutral on financial conditions. And to be honest, looking at that left-hand side chart, you can see that basically what we did was we touched the line and went back down, touched the line, went back down. So we never had a meaningful movement into accommodative territory that was sustained. Turning to the next slide, slide number 14. Basically, Federal Reserve policy, I mean, they've essentially hung the gone fishing sign out. If you look at this is the infamous dot plot that came out from the June after the June meeting. We'll get another one in the middle of September. But basically, the Federal Reserve believes the policy is going to remain unchanged. We're going to have a federal funds rate target range between 0.25% all the way through the end of 2020. So it looks like there's going to be, unless something surprising happens on the growth or inflation fronts, basically we're going to be living in a low administered rate environment for the next 2.5 years. Turning to the next slide, Not only has the Fed reduced the federal funds rate target to the effective zero lower bound, but also they've boosted their holdings of securities since the crisis began. And as of last week's report, the Fed's holdings of securities, Treasuries, federal agency debt, mortgage-backed and commercial mortgage-backed securities, they're up about 2.3 trillion from where we were in the midst of before the crisis began. You put that on top of the fact that the Congress and the administration have put in place $2 trillion of stimulus, and there's probably more on the way once they can sit down and hammer out a phase 4 agreement. This is a lot of the reasons why the economy's come back so quickly, and financial conditions have moved back into an accommodative stance. Turning to the next slide, what does this mean for interest rates? Well, interest rates basically they're going to remain low for an extended period of time. The consensus is basically that over through the fall of next year, we're going to have gradually higher rates, gradual increases in rates, especially on the bill portion of the curve, and a gradual steepening of the yield curve over the next 18 months. But again, longer rates, 30-year bond rates, are going to remain well shy of the 2% mark. So I mean, the long-term outlook for Treasury rates is that we have a marginally higher rates and a steeper curve through the fall of next year. Turning to the next slide. In our own area, things have picked up a fair amount of steam over the past several months. The manufacturing sector has come all the way back. I mean, we now have increases in new orders. We're basically got stable employment in the New York area on the factory front. Composite measures that include inventories, vendor deliveries, and production. They're back above the 50-point break-even mark, and firms in the manufacturing sector of the local economy are more hopeful about the conditions that will be prevailing 6 months from now. Turning to the next slide, service sector is a little different. Service sector activity in the left-hand side panel, the aggregate activity, it has stabilized after a sharp decline. But service producing firms in our area, and this is a little bit broader. This includes the whole Federal Reserve District. So this has Southern Connecticut, Northern New Jersey in there as well. Firms remain very concerned about the business climate. The business climate index, which is shown in red there, basically what that tries to gauge is whether or not firms feel that conditions are better or worse than normal. And you can see they still are pretty pessimistic about things, even though employment and wages have recovered. And it's pretty much the same as we go into the next 6 months. They do remain concerned about the future business climate, although business activity should improve as well. Turning to the next slide, this looks at labor market conditions in our area. They're essentially a mirror image of what's going on in the country nationwide. We continue to see declines in initial jobless claims across all segments of our coverage area, which includes New York, New Jersey, Puerto Rico, and the Virgin Islands. And we have seen significant reductions in the insured unemployment rate in our district. But again, as was the case with the national numbers, we have a considerable way to go before we will be back to normal. And again, I think these figures are going to be incumbent on how quickly we get the service sector economy in our district back up to where it was before the pandemic hit. Turning to the next slide, real bright spot, and I'm not sure people are giving it enough attention. A real potential bright spot going forward is the housing sector. Now, before the crisis hit, housing had its first meaningful contribution to GDP growth in the first quarter, that it had in a long time. But with these continued reductions in mortgage interest rates, in particular, longer-term fixed-rate mortgage terms are now at all-time lows. It's providing significant lift to housing across the country. You can see that since the worst of the crisis, we've had a huge increase in home purchase mortgage applications nationwide, and that's apt to continue in coming months as rates remain low. Turning to the next slide, what does that mean for home sales? Well, I mean, if you just look at the way things work, we get a mortgage application, we have a sales contract, and ultimately we have a closing. Pending home sales or contract signings, existing home sales, closings. The data that we have in hand suggests that at least over the course, right now, existing home sales, both nationally and in our area, are a coiled spring. And they suggest that we are going to see a sharp snapback in existing home sales or closings over the summer months. If you look at pending home sales in New York, for example, and New York and New Jersey, which is in the right-hand side panel of slide number 21, pending home sales since April have risen about 150, over 150%. So this should be a pretty decent. We know that these pending sales are ultimately going to be closed. It's just a matter of time. Traditionally, the lag between a contract signing and a closing is generally 1 to 2 months. It may be a little bit longer now because of the social distancing restrictions that we're all living under. But again, not only does it look like the consumer's coming back, but we may get an add-on impact of a better housing sector forward as the recovery takes place. Turning to the next slide, just looking at mortgage performance. The latest numbers that came out the other day, we did see a big pickup in the percentage of delinquent loans nationwide from where they were a year ago. If you look at the left-hand side panel, we can see the 30-day past due delinquency rate has gone from 3.6% in May of last year up to 7.3% this year. We've seen not as dramatic, but similar increases in loans 30 to 59 days past due, 60 to 89. Right now, there hasn't been any change in the loans 120 days past due, and the foreclosures are actually down. The other encouraging sign is that it looks like the number of loans in forbearances, all while still elevated, are coming down across holders. We can see that in the chart, the right-hand side chart in slide number 22. As far as the other data that we should keep an eye on, and again, there have been more and more stories coming out that you've got to be careful with these numbers. It's how many COVID tests we are able to conduct today and what the percentage of those tests are that are positive. If you look at similar experience across other countries, you want to get the percent positives below 5%. That's a meaningful sign that you're making significant progress in stemming the outbreak. We're running, generally around 700, 800,000 tests per day, but we have to get those numbers out in order to reduce the percent positives going forward. As far as the healthcare front is concerned, there's growing optimism that we will have a vaccine, at least one vaccine, available by the end of this year. Now, if that's the case, it may not impact our growth numbers this year all that much. But what you will see, if there is a vaccine, expect economists and official institutions to push their forecast for next year's growth significantly higher. For example, the Federal Reserve in their last summary of economic projections, they expect a 5% calendar year increase in growth, in real GDP growth next year. That number would certainly move higher if we do have a vaccine by the end of this year that's in place and becomes widely available. And one final encouraging sign is that when we look at our own business at the Federal Home Loan Bank of New York, because we're a stable provider of liquidity in all operating environments, we tend to experience sharp increases above trend in our advanced book when we do have these financial crises. You can see that there was a sharp increase in our advances during the 2008-2009 economic downturn, and we saw a similar increase during the pandemic of this year. The encouraging thing is that once our advances compared to trend peak, it is a sign that the worst of whatever economic malaise we're suffering from is over, and it's just a matter of time before we're back on the road to recovery. And with that, be more than happy to answer any questions that you might have.
Sure, Brian. Thank you. A great presentation. I had one question for you myself, and there's a few questions that the members have asked. So let me start off with mine. And it pertains to the stimulus packages and the several $1 trillion worth of spending. And we have more stimulus packages to come. Brian, what do you feel the long-term impacts to our national economy will be for adding several $1 trillion of debt on top of what would normally be, or would normally believe to be an enormous amount of debt outstanding?
Well, I mean, what we were all taught in school is that whenever you get a big increase in government debt issuance, you get crowding out. So what happens is, because of the credit demands of the government, you end up crowding out private sector borrowers, and you get an overall increase in the level of nominal interest rates. That hasn't happened. I mean, we've been actually going in the opposite direction for several quarters, where even in the midst of increased Treasury issuance, we've actually seen a lower interest rate environment. So, I mean, I think the profession in general has to go through a major rethink about the whole crowding out thing. I think it only becomes a problem when the people who take down our paper start to pull back, and they start to say, "Well, look, I mean, there's so much of this stuff outstanding. I'm not willing to buy a 10-year note with a yield of 0.6%. It's got to be significantly higher." Now, when that prompts an increase in general interest rates, that's when it becomes a problem for the economy. The one benefit that you do have, if in the United States, and the UK has this as well as Canada, is that unlike countries that are involved in the European Union, the debt that we're issuing is denominated in our currency. So, for example, we will never have the problem that Greece, for example, had, where they've got their debts denominated in euros, and they're not the country that's issuing. So, I mean, the textbook thing is that we end up with higher interest rates over the course of time. But again, certainly nowhere near that. The other thing that you would look out for is to see what the results are of the auctions, whether auctions are tailing, or, in the case of Germany, we've seen it where auctions actually fail. So that would be a sign that you're in trouble. But I don't think we're anywhere near that right now.
Okay, thanks, Brian. All right, so I'm going to go, with that being said, there's a member who asked a question regarding the yield curve, the Treasury yield curve, and he points out, or she points out, that the 10-year Treasury is at 69 basis points today, and members really are impacted by this ultra low rate environment. Really reduces their earning and net interest income earning capabilities. What will it take for the 10-year to normalize? I know in the presentation you had said that we're in this the Fed is forecasting a low rate environment for the next 2 years. What do you think, what will it take for the 10-year to get back to 2.5%, 3%? Are we, is that anywhere in our lifetime?
Well, I think it is, but I mean, when I say about a low interest rate environment, what we're talking about there is the federal funds rate. They're going to hold steady, at least out through the end of 2022. Basically, the remainder of the curve, it's a function of what happens with the pace of recovery we have, what type of inflation environment it prompts, and what's going on overseas. I mean, one of the things that you have to bear in mind when you look at the Treasury yield curve is that part of the reason our rates have been so low in this country for an extended period of time is that other countries don't have any basis points. They've got negative interest rates. So as low as our rates are, they're attractive relative to investors overseas. If you think about it, I mean, I have a hard time with negative interest rates. I mean, I think I'd rather, get a vault or get a safe deposit box. I mean, why would you lend somebody $100 to get only $95 back at the end of the year? I mean, you'd be better off spending them, which is what negative interest rates was supposed to do. It was supposed to force people to spend, not save. But I think, what I would bear in mind, though, is that if we do get a sharper than expected recovery, the way the timeline works is you get the pickup in activity, you start to gradually see some improvements in increases in inflation, and then whether the growth environment is sustained, that determines whether or not your inflation numbers move significantly higher. Now, on the inflation front, the last 2 months, there have been some pretty encouraging signs. I mean, you had a pretty massive increase in consumer prices in the month of July, and it was widely spread across all components. I mean, the core index was up 0.6%, which I think is the largest 1-month pop since 1991. So, I mean, the one thing that I would bear in mind is that things could change. They could change quickly. I mean, especially if, for example, we wake up tomorrow morning and you find out you've got a vaccine. I mean, what I would take right now as being a reasonable format for what might happen through the end of next year, I would use those interest rate forecasts that are in that chart that I showed previously. Basically, you get a gradual. Let me just go back to that actually. So you get a gradual pickup in rates over the coming quarters, and you end up, the terminal point on this has 10s at 1.2%. But I mean, if the growth picture changes, what you'll see with these consensus forecasts, and I'm back on slide number 16, these things creep every month on the basis of what the latest information is. So what will happen is when you get a new round of consensus forecast, if the economic environment is improved, you'll see this whole packet of quarterly forecasts move up. If it's getting worse, you'll see them all move down in tandem. But again, remember, these are median forecasts. This is what the average thinks. And the one thing about interest rates, though, is that let's be fair about it. Economists, we're miserable predictors of interest rates. Typically, if you tell me that you think 10-year treasuries are going to get to 1.2% in the final quarter of 2021, if you think that's going to happen, it's going to happen much more quickly than we anticipate. I mean, it's the old joke amongst economists: give them a rate, give them a date, but never give them both.
Okay, thanks, Brian. All right, I have another question or two. This next question comes from a member, and it reads, what impact would a change in the administration have on the economy?
That's a tough call right now. You would have to think that with if you have a change in administrations, a change in parties, what becomes crucial there is whether or not the Senate switches as well. My guess would be with the coming election that the Democrats hold on to the House. Then the important thing there would be what happens in the Senate. I mean, regardless of who occupies the White House, I mean, if you have divided government in Congress, that can basically keep the status quo going for an extended period of time. I mean, if all other things being equal, you would think that if you get a Democratic administration, that you'll get increased taxes and things like that. The Republicans should get a status quo. But I think the real question, maybe the most important thing, is not what happens in the White House, what happens in Congress in the upcoming election, and whether or not there's a swing where the Democrats have control of both houses.
Okay. Thanks, Brian. Another question relates to manufacturing. You had said we're back to pre-crisis levels with manufacturing right now, and due to reduced globalization that had been the trend prior to leading into this crisis, do you anticipate manufacturing to continue to be robust, and will manufacturing or will the pandemic have influenced manufacturing even further, where more jobs will be brought back to back to our shores? So will the pandemic accelerate that trend to bring back manufacturing?
Yeah, I do think this pandemic is going to have a lasting impact on globalization. I think firms, as a result of what has happened here, they initially have to just rethink their supply chains. But I also think that the severity of the economic downturn is going to make them question whether or not it's best to produce overseas in the lowest cost producing country. In case something goes wrong, you want to have some domestic production. So even if you consider the added domestic production as precautionary, it's a positive going forward. The question is, how do American consumers respond? American consumers respond to pay a little bit more for, say, a pair of jeans that are produced in Milwaukee than those that are produced overseas. So I mean, the question is whether or not get a behavioral shift in consumers as well, and you very well could. I mean, all that'll be difficult to gauge, and it's something we won't probably have concrete evidence on for another 5 to 10 years.
Okay, thanks, Brian. Thanks, Brian. And then the last question, someone wanted you to comment on the state fiscal crisis, or the fiscal crises that is present in many of the states. How is that going to play out, and how would that hinder the recovery out of this pandemic?
Well, I mean, the question is whether or not they get any relief from the federal government going forward. But obviously, that's going to be a damper on growth going forward. I mean, the best thing I think for state budgets is that we put as many people back to work as quickly as we can. I would say that, as I said before, if we get something that's reliable and ameliorating the COVID, if you get it, or a vaccine for it, that would be a net positive. But I think for states, barring any direct support from the federal government, you're going to have you need to pick up an employment. You need to pick up an employment, pick up an economic activity, because that's your tax base.
Okay. So thank you, Brian. Now that concludes the questions. Really appreciate your presentation, and I want to thank everyone for attending as well. I just wanted to let you know we are having some upcoming webinars, no more for August, but the next one is on September 10th, and that pertains to our new secondary mortgage program that we're rolling out. It's called the Mortgage Asset Program. We've had several webinars on that topic. If you haven't attended, I strongly urge you to attend the September 10th session, because it's a fantastic program. There's a lot of compelling reasons to participate in that program. And I think it's going to be very successful, and we want to make it a success for our membership. So if you could learn more about that program, I think you'd find some compelling reasons to participate. So September 10th, and then the next one is going to be on September 24th. A friend of ours, Ray Chandonnet, who used to be with Sandler, he's now with a group called Neocova. He's going to be talking about digital transformation simplified, and he's going to talk about how our members, big and small, can embark on the journey towards enhancing their technology and growing their technology to transform their business and to create a larger customer base and enhance profitability. So that concludes our session for today. I want to thank you all for attending, and I look forward to seeing you on the next session. Thank you very much, everyone.